Everyone. I hope you can hear me okay. We do have quite a few people yet to join us, but look, we'll make a start and yeah, hopefully the remaining registrants can join us pretty soon. So yeah, my name is Glenn Waldock. I'm one of the directors here and going to be running through um, the ATO and Big Brother is watching context. So hopefully I won't bore you too much. Um, a little bit of housekeeping. I cannot see you. I cannot hear you. Hopefully you can see and hear me okay. Um, we've got the session scheduled for an hour, but I'm quite confident it won't take that long. So hopefully have you back at work or whatever well before then. Look, if you do have any questions throughout, then um, please do not hesitate to ask a question. You'll have to ask the question via your chat box at the bottom of your the Zoom screen. So if you can't hear me or see me, then please, yeah, put a chat up now. Shane, our coordinator, is in the background. She'll be able to hopefully answer any technical questions. But yeah, feel free to type in a question throughout and yeah, Shane will let me know when they're there and read them out. So without any further to do, let's go. So, yeah, just the usual disclaimer, just for general information only, obviously. So, what we're going to be covering today is the ATO's data collection powers, ATO data matching generally, their audit activity and focus areas. And this is more in a broad sense, but also what they've said they're going to be focusing on in this current financial year as well, and some other ATO news generally. Okay, so data collection. So for a while, we've known that the ATO, look, they have far-reaching powers and they're only getting better. But yeah, for some time, we've known that they know when you sell a property, when your income doesn't match your lifestyle, when you deposit income from overseas, and when you transact in shares. So buying Telstra shares or BHP and the likes. So I'll run through each of these in a little bit more detail. So how do they know when you sell a property? Quite simply, Landgate. So in WA, Landgate control all the property transactions, and they're all registered. So yeah, they will know what houses we own, and they certainly know when we sell a house. So uh, we get information from the tax office to do tax returns, for example, and it will have a pre-filled section that they've sold, that someone might have sold such and such a property. But often, if it's their main residence, then there's no tax implications anyway. It's just, I guess, evidence that they know when these things happen. Income doesn't match your lifestyle. So this is the most interesting one probably. And this generally only really comes into play if you happen to be the subject of a tax office review in the first place, or there's some reason that they might want to be looking into your affairs. So yeah, we personally haven't seen this a lot. We do know it happens. We get training with court cases that have happened in recent times, and we certainly know the ATO do this if they've let's say smelling a rat or have a reason to look into someone's affairs. So naturally, they will know what income you're declaring through, let's say, ourselves when we prepare tax returns. There'll be a taxable income number, so that's quite obvious. They'll know what you're reporting. But if they've got suspicion that your lifestyle purports to be you're much wealthier than you're reporting, or what income you're reporting, that's when they will look into you more closely. So yeah, as I mentioned, they can tell what properties you own via Landgate data. They can tell if you're own shares in a private company, then they can tell what shares you own in that private company through ASIC registers. And just as an FYI, the ASIC register is a public database, so anyone can search ASIC For a small fee, you can find out who the directors and shareholders are of any company in Australia, really. So that's yeah, not really groundbreaking for the ATO to know as well. Via share registries, they can tell what listed shares you own, and they can tell what vehicles you own, what boats you own through, obviously cars need registrations, boat need to be registered. They get information from insurers as well, and through the PPSR, which is the Personal Property Securities Register, if you take out a loan to buy a car, boat, house, then the financier, let's say Westpac or Commonwealth, they will register that item on the PPSR. So that's another source of public information, certainly that the ATO can access as well. Horse ownership, through the thoroughbred licensing, they can tell, excuse me, yeah, if you own a horse. And look, it's probably not uncommon for certain type of assets, properties, cars, houses, to be put in spouses' names or a company name or a trust name. But through digging deeper, I suppose, in searches and on tax returns, there will be a requirement to say who's spouse. Then it's not difficult for them to track what assets are owned by a spouse, for example, or a company that you control. So you might think get away with something by not having your name. It just means they might take a step or two to establish what you own via a group that you're involved with. So yeah, look, fear not, they don't record or collect data on every single car or caravan you might own, like a $10,000 secondhand car. They do have minimum asset thresholds. So this is the thresholds of the certain things that you might own. So caravans and motorhomes, $65,000 or more is only what they're interested in. Cars, trucks, motorcycles, again, 65,000 is their threshold. Thoroughbred horses, as I mentioned before, that also happens to be $65,000. Don't ask me where they get that threshold number from. So obviously anything less than these numbers they feel is not material enough to, let's say you're rich or something like that, which is a good thing. Otherwise the database would be exploding, I would imagine. Fine art, $100,000 they've put on that. Marine vessels, boats, again, $100,000, and aircraft, $150,000. So not that I own a fishing boat or a ski boat or anything, but I would assume there's quite a lot out there costing less than $100,000. So they're only interested in the bigger picture things, as you can see. And they'll collect data from especially insurers on the values of things that what you might insure them for on their, they'll have a database. So yeah, that's on lifestyle assets. Bank deposits, so there's no limits to any cash deposits anyone can make. So Shane, I'll stop there. No questions, anybody so far?
No, all good at the moment, Glenn.
No worries, thank you. So yeah, you've no limits to cash deposits anyone can make. However, amounts exceeding 100,000, 10,000 Australian dollars, they must be reported by banks to AUSTRAC, which is the government organisation responsible for keeping track of these things. So yeah, look, and it's just because you're depositing 10,000 in cash or more doesn't mean you're up to anything dodgy. It just means they have the capacity to dig deeper and form a view. So many people might sell a car for cash. Doesn't mean you need to be worried the ATO are going to track you down. If you ever happen to get a question on what it is, then as long as you can justify where the money's coming from, then you've really got nothing to worry about. They're really trying to get hold of I guess black market dealings or income that you might be earning that you're not reporting ultimately. So yeah, that's where the bank deposits come into play. Similarly, money from overseas has the same Australian $10,000 threshold. Banks are required to report to AUSTRAC movements in cash of that nature as well, for the same reasons, really. So obviously in Australia, our government try to treat as many people as tax residents as possible, even those that might have some kind of domicile in another country. You can be a tax resident of two countries. So our tax act says that you're required to report income that you earn from Australia and overseas. So I guess from that, they're trying to capture that you might have business dealings or property or investments overseas that you're selling and bringing back to Australia. Technically, yeah, they want to get their tax dollars on those kinds of transactions if they're subject to tax, that is. So yeah, pretty powerful on what they can track. Transacting in shares, naturally, all listed shares belong to a share registry. They can get the information from share registries and brokers as well. So again, in more recent years, I guess assisting accountants and the like preparing tax returns, we will be able to see when you earn dividends from these listed companies. They're already pre-filled and reported, and often they can see if you've sold a bundle of shares, of listed shares, that is. It won't say what capital gain you've made, but it'll definitely know the numbers and the date of when you've sold these things. So it's very hard to get away with. So yeah, they've been able to do that for a while, and they're obviously getting better at crypto. So the Bitcoin and the like have exploded, I guess, in recent years, and they're playing catch up to some degree. Where maybe 5 years ago they might not have been able to report on crypto activity, but these days they certainly can. So yeah, I guess a bit of a beware that. That's a classic case of Big Brother is watching. They've been able to, improve technology and find out when these things are happening. And naturally, AI. AI is affecting all of our worlds in a good way sometimes, in a not good way in other times. But yeah, clearly the tax office are using AI and technology to enhance how they do their data matching and how they find information when they need to. Okay, so they're the main things. They also know what super, with general changes in single touch payroll laws in probably the last 5 years or so. As if any of you listening are employers, they know what superannuation you should be paying, to who you should be paying it, and they know this quicker than they ever knew before. Again, with live time reporting, single touch payroll, it's very easy. So because they know that you are late, if you are late making your super payments, and I'll touch on this a little bit more, but that is clearly a low-hanging fruit for them in picking up late super. And they know, what your individual's income is quicker than before through various, again, single touch payroll is the main culprit there. So interestingly, this is straight off from the ATO is in regard to moving on to data matching. So they've said matching external data with our own helps us to ensure that people and businesses comply with their tax and super obligations, and it also helps us to detect fraud against the Commonwealth. So yeah, they're in the game of collecting the right amount of tax where appropriate. So they'll use whatever powers necessary. So these powers go back to the Taxation Administration Act 1983, so been around for quite some time, but they're also adhering to Privacy Act 1988, which means they can't share, generally can't share your information with others, but they can collect it using those powers. Any questions, Shane? Nothing yet?
No questions yet, Glenn.
No, hopefully I'm not bamboozling anyone yet. So again, with data matching, they have over 60 sophisticated identity matching techniques from the horse's mouth. I don't know what they are, but that sounds like a lot. And they use multiple identifiers to obtain an entity match. especially with identity theft and fraud more and more prevalent, probably in the last decade. Yeah, their technology's catching up and probably very strong in trying to detect any identity theft. Hopefully that hasn't happened to anyone listening, but we certainly have had cases where hackers have logged into somebody's MyGov. They've hacked into their MyGov, somehow prepared a tax return with obviously fraudulent claims to generate a refund, and have actually been able to lodge the tax return and obtain the refund from the tax office. And it's only when we have gone in to prepare that same person's tax return, that might be a month later, might be 4 or 5 months later, we've uncovered that the tax return's already been lodged, and found out that it's via, fortunately, not hacking in through Byfields, thank goodness, but hacking into the MyGov platform. So I don't think there's anything you can do about that other than having very strong passwords. And it's not common. We've only seen it probably 3 or 4 times, and that's 3 or 4 times too many over the last few years. But just goes to show, the hackers are getting quite clever. So I guess government and ATO protocols are getting pretty heavy as well to try and stop this as much as they can. And yes, so additional processes manually might be undertaken by staff to help the matching process, and they have data analysts using various models and techniques to detect discrepancies. So they clearly take that pretty seriously. I won't run through these one by one, but this is just a screenshot of their current data matching protocols as we speak. So things like AUSTRAC, which I mentioned before, they get data from the Australian Electoral Commission, Financial Crimes Exchange, crypto, as I mentioned, going down to the bit in purple, lifestyle assets data matching program. All the way through to Department of Home Affairs, which looks after immigration, novated leases, private health insurance. So, not an exhaustive list, but just shows you what they've got currently in place with third-party providers. A little bit scary. So no questions so far on data matching or
no questions showing up yet, Glenn. I've put a message for everyone. If you do want to ask a question, just put the message in that little chat box, and I'll read it out to Glenn. Yep. Thanks, Glenn.
Thank you. So moving on to ATO audit activity and their focus areas. So they have what they've documented as a broad areas of focus, and they've also got areas of focus for the current 2025-26 financial year. So from a broad area, they look at non-lodgement. So naturally, they want everyone to stick to the law and lodge your tax returns and lodge other documents when you're supposed to. Activity statements, superannuation and the like. They can certainly, their computers can pick up quite easily when someone is late doing that. Trusts has been a big area of focus in recent years. Quite a few of you listening will likely have a family trust likely in your structure somewhere. There's nothing to be concerned about. They're all legal and legitimate, but because of let's say the tax advantages that can be afforded to trusts, they are trying to clamp down on that as much as possible. They're probably the bit of the bane of our existence, where a lot of our clients have trusts and they're good vehicles to have. But the ATO certainly is trying to make it a little bit harder to not so much operate through a trust, but how income is allocated and the likes. An example is they've just changed their interpretation of a law that's over 40 years old, where allocating your trust income to your 18-year-old child at uni was once not seen as anything dodgy. They're now yeah, they're wanting the money physically paid over. So if any of you that have trusts, hopefully you've probably had discussions with your accountant here in the not too distant future backwards to talk about this. International transactions is obviously a big focus area with the world becoming smaller and people holding wealth outside of Australia. They're pretty hot on trying to capture anything that's untoward or missing out on tax revenue through selling a house overseas and things like that. Private company benefits. So yeah, for you listening, if you don't have a trust, you may well have a private company that you're involved with. So yeah, they're quite, there's something called Division 7A, which you've probably heard us ramble on about over time. That is really, Division 7A is all about the realms of if you're getting tax-free benefits out of your company, that they don't like it. So that's probably our job to help you keep compliant there. Property and construction, they generally look at. An example they gave there was those that are involved in flipping houses, and how you're declaring your revenue, something called revenue account versus capital account. Are you registering for GST and the like? So just making sure people are lodging or reporting income correctly from any making gains on flipping houses. It's just there's one of those things they're looking at in that industry. Business structure is quite a wide range of things they look at. They look at if there are any incorrect tax consolidations, if there's any companies that are reporting on the incorrect tax rate. So just to make life difficult in Australia, there's two company tax rates, 30% and 25%, if you weren't aware. So they want to make sure companies, are paying the correct rate. They're looking at self-managed super fund assets, if you're using your self-managed fund correctly. And they're very strict on that, obviously, but unfortunately, that people do try and use that super money for things they're not supposed to. And research and development claims is the other thing they're looking at in that realm. They're looking at transactions and taxes, which, to be honest, pretty much covers the whole of the tax system. Fringe benefits tax, capital gains tax, GST. So it's a really wide gambit of things they're looking at there. Private wealth advisor program. That's I guess focusing on the professions like ourselves and financial advisors. Not only is there a high expectation level of, I guess, advisors being compliant and paying their taxes on time to set a good example, they're also looking at what advice we give and financial advisors are giving as well. So yeah, naturally, they would see advisors do have an input on how taxpayers report their income and declare the right income. So yeah, a focus on us to some degree in that respect, which is probably fair. Tax crime. An example of tax crime is Phoenix activity. I'm not sure if anyone's familiar with that. I guess in broad terms, it's when you run a business into the ground and rack up a lot of debt, so people you owe money to, and then close that business and go and start up another one the next day and burn a lot of people. So that is a crime. And ASIC are usually the organisation that look at phoenixing, but that's just an example of tax crime. And, succession planning, tax risks, I guess when wealth moves from one generation to the other, which might be selling a business or a property, or moving it on to the next generation, it's capital gains tax they're really looking at there. Has the older generation or the seller reported correctly and paid the right amount of capital gains tax, if any?
So, Glenn, I have a question.
Sure.
From Therese. Therese is asking, will they pursue an employer if a day or two late with a super payment?
Good question. I've got an example on that coming up, Teresa. But shorter answer is yes, they can. Will they pursue? I don't know. They can choose not to, but Yeah, look, I doubt everyone that's paying super a day or more late is getting a please explain letter. Um, and I don't know what protocols they'll follow to pick on you and not me and not the other person. But short answer is yes, they can. Absolutely, they can. And I'll run through an example of what the implications are of paying super a day or two late coming up. So yeah, so 2025, 26 areas of focus. There's some common denominators with what I just ran through. So they say they're looking at privately owned and wealthy groups. And by definition of what a wealthy group is, they look at individuals or individuals' associates with net wealth of more than $5 million. So probably not a big amount in the scheme of things. They have something called a top 500 program, which looks at the most wealthiest, I guess, groups in Australia, and that's when they control assets of more than 500 million. So much bigger numbers. I think that's the top 500. They would be, from our tax training, they are examined quite closely. Not to say they definitely get reviewed or get audited, but I suppose once you're on their radar, there's probably an annual compliance system these groups have to follow. So if you're in that category, congratulations, you've done pretty well. There's also a Next 5,000 program, which looks at groups that control assets of more than $50 million. And there's a medium and emerging taxpayer program where if you're between 5 million and 50 million, you could well be under their scrutiny, I suppose. And I guess even though they've got strong powers, the ATO does have probably finite resources. So just if you do, in the event you do control assets in those categories, it doesn't mean you're going to get a letter tomorrow. It just means, yeah, you're more likely to be probably coming under review than someone under those thresholds. Core tax and compliance issues, that's something they're probably always looking at, but they're looking at, have you registered for a tax file number for GST, ABNs, for example, when you're supposed to? Are you lodging on time? Are you paying on time? Are you reporting the correct amount of income? Are you declaring capital gains as you should? And trusts, again, is a current year focus, as I mentioned, for the same reasons as before. They're looking at are they using business money for other purposes? So companies, as I mentioned, and that Division 7A. So hopefully, yeah, if you're trying to access your company money, again, nothing dodgy or illegal about it. We've just got to do it the right way. And yeah, hopefully we give you the correct advice on some options on how you want to access your company money properly. Lifestyle assets, as I mentioned before. Succession planning is a focus this year, again, coming under probably capital gains tax reporting territory. Now, the specific industries they've said they're coming out to, or they're targeting this financial year, is tax advisors and professional firms, lucky us. There's actually I'm not sure if I've covered it later or now, but no, I'll cover that a bit later for what's new and what we have to comply with these days. Property and construction, I mentioned that before. Private equity firms, retail they're focusing on. They say there's quite a lot of GST emissions, sometimes through point of sales systems not being set up correctly. Not that people are trying to do anything illegal, but just by accident, not remitting the right amount of income. They're talking about vouchers, not declaring income from voucher sales correctly. So again, trying just to, I guess, assist retailers in complying what they will say, not so much an audit or targeting different organisations. Cross-border transactions, that's all about foreign income, declaring the right amount of tax on earnings from overseas. And incidentally, I think the tax office and everyone knows people do inherit money from family. So just because you might, again, deposit a large sum of money into a bank account from overseas, you don't need to fear that you need to hide it under a mattress or something, because yeah, that happens a lot. Not mattress hiding, but inheriting money. So again, as long as if you do get a question and you can justify what it is, then you've got nothing to worry about. Crypto, they're ramping up their focus on crypto trading and people not declaring gains. Use of tax-exempt or concessionally tax entities. Again, self-managed superannuation is an example they gave there, where yeah, you're using the assets inside super incorrectly, and not-for-profits is another one. Example, using those type of entities for the wrong reasons or for the wrong benefits. Retirement villages, cracking down on, I'm not too sure why. Application of GST is one example they gave there, that they think that is being misreported. And GST refund fraud, I think, is always going to be prevalent for them through, unfortunately, businesses putting in fraudulent GST claims. Look, as a general, it's a self-assessment system in Australia. So if you do lodge anything knowingly incorrectly, you may well get away with it. But we do know they can open files, a year, 2 years past something that's happened, or transactions that happened. And if they do discover that something has been untoward and it's intentional, interest and penalties can be severe. So I guess they trust, or they want people to do the right thing. But if they discover they're not, they can be a little bit nasty.
Glenn, I have 2 questions.
Sure.
So firstly, it looks like the chat box is being a bit problematic. So people can go over to Q&A, just a couple of buttons over, and you can put your questions in there. So 2 questions. First one is from Martin. He's asking, car loans that get reported via PPSR, what about car leases? Is that the same?
Good question, Martin. I'm not sure. If it's a finance lease, and the dealer or the third party wants to retain a level of protection and ownership until the final payment is made, then yes, I would say so. But certainly, chattel mortgages are very popular these days. High purchases, I would say they would always be reported by the lender on the PPSR.
Second one, it's from Martin again. Also crypto reporting, are they data matching with Swiftix? I think that's how you pronounce it.
Okay, I don't know is the short answer. We encourage clients who trade crypto to subscribe to, it's called a crypto tax calculator. I guess one of the main reasons is, it's highly complicated, and you can have platforms from everywhere and anywhere. So if you are trading, it's very difficult and I guess time consuming from our end to try and work out, have you made a gain or have you made a loss? So this platform helps to that respect. And I can only assume the ATO can do similar, but Swiftix, sorry, Martin, I haven't personally heard of that one. I don't dabble in crypto myself, but I'm sure there's a colleague or two here that might have heard of that.
So that's all the questions for the moment, Glenn.
Okay, no worries. Thank you. Okay, so moving on to a couple of recent audit examples. So I think it was Teresa that touched on or had a query on super. So we did have, this is a real life example for a client of ours. Super for a particular quarter was paid late. They did have an ill parent that was taking up time, and it was a clear distraction. So they missed the deadline of when they were supposed to pay the superannuation by. They did pay the correct amount of super a few months after the due date when they got back on track. We got a letter from the tax office. It's pretty much a superannuation audit. 18 months later was the scary thing. It wasn't a few months after it happened or on the spot. It was a year and a half later. So a part of that audit, they're called super guarantee forms, need to be prepared, and that is what needs to technically happen if you do pay super even a day late. You're supposed to voluntarily complete the forms, and almost you're putting your hand up to say, yep, we're sorry, we've paid late. And there is a interest component, which I think is 10%, that you're supposed to add on top of the amount that you owe or that you're late with. And I think it's a $20 nominal fee per employee that you're paying late. So that's what the forms are there for. Now, in this particular example, there was a $6,000 nominal interest charge payable by the client in addition to the actual super. So it's not just enough that you pay the super on time, or so pay the amount of super even if you are late. It's the interest charge that's the killer. And there is no way that we actually tried to get this interest reversed for this example. But there's no way the ATO can actually reverse or reduce interest on late super. It's just not even in the legislation for them to be able to do it, unfortunately. There are other type of taxes out there that we do have some success in reducing interest or reversing it if there's a good enough reason, but superannuation interest is one field that we cannot, unfortunately. So what happens is the interest is calculated from the original due date until lodgement of the forms. So let's say you are a week late. If you were to put your hand up and prepare the forms then and there, then you're only paying interest on 7 days of the late super. But if you, let's say, didn't and you got a review, and just remember with a single touch payroll, they can find this out pretty easily and hammer you pretty easily than they could before. Let's say a year later, they find out that you paid 1 week late. The interest ticks from the original due date up to a year. So, or when the super guarantee forms are lodged, which might be a year plus another month by the time you get onto it or you get our assistance. So that's the kicker, I suppose. Interest starts ticking from the time it's due to the time you lodge your forms, and that's often when you either get found out or you realise that you've paid late. So I guess, yeah, it's a warning, I suppose. The best thing to do is if you realise you're late is to reach out to your accountant and say, look, we're late, get the forms done, and at least you're locking in the interest for maybe a week or two. But I guess it's a gauntlet to run if you don't, and you are discovered 18 months, 2 years later, then you got potentially 2 years worth of interest to pay that we cannot get back. So that's just how much teeth they're showing in this field. Another example is more about work-related expense claims, which they haven't come out and said it's an audit focus of theirs for this financial year, but it doesn't mean they can't audit you. So it's just not dedicating as much resources to this field as they are to the other fields. But yeah, certainly it's not going to escape an audit if you're trying to push the barrow too much. So in this case, there were some large work-related expense claims made. It triggered an ATO audit because those claims were probably exceeded what the ATO's computers would see as reasonable. It was a time-consuming effort for them and for ourselves to provide the ATO with the substantiation and justification for the many, many claims made. And it's a bit of a plug for audit insurance. If you don't have it, I'm not going to push that whatsoever, but it was handy because that covers our time to deal with the ATO on your behalf. In this case, some claims were disallowed on the basis of lack of nexus to the income they earned. And they issued new assessments which triggered more tax and interest on that more tax. So the picture in this slide gives you a bit of a hint as to where the people might have been staying to come up for training and seminars. So not that that's illegal, but the ATO, yeah, probably not stupid. There's probably a limit where I say, well, that's reasonable versus that's over the top. So in this case, yeah, they had quite a few expense claims disallowed. And I guess the not unfortunate, but if you are the subject of an audit in any given year, there's a fair chance that you will remain on their radar for potentially the year after and the year after. It doesn't guarantee you'll get an audit every year for the next 5 years. It just means you're probably more on their radar than your neighbour who hasn't been subject to an audit. So try and do the right thing. Interesting fact. So yeah, the ATO collected 4.11 billion in outstanding tax liabilities last financial year. So that's clearly, I think they collect like 805 billion in tax revenue as a whole, but this is just of people that hadn't been paying their tax on time and what they've gone and collected. And I guess scarily, of that, $331 million was interest and 1.16 billion in penalties. So they are active in that space. I guess it's a good revenue collector for them. So yeah, a bit of an example of why they're doing what they're doing. It's worthwhile for them from a revenue sense. Okay, so moving forward to just a bit of other news. Payday Super, for those that weren't aware, is proposed to come in next 1 July 2026. It's not law yet, but yeah, who knows? It's probably more likely than not to come through. That just means that when your superannuation is paid to your staff in your pay cycle. So if you've got a weekly pay cycle or fortnightly pay cycle, that's when you'll have to fire off the superannuation amount and not once every quarter. So again, that's just one more compliance hurdle, and all the software packages that you pay the payroll through will no doubt be updated, but I would say that's more likely than not to come in. Trust and Section 100A, you might have heard us talk about this if you do have a trust, but yeah, bigger focusing on how trusts allocate their income, that is about, and allocating to adult children that don't have anything to do with the business. Excuse me. Yeah, there's a few options to try and mitigate that, but that is a little bit more concerning. As I said, a couple of years ago, this wasn't a thing, and now it is. So that's just an example of where they're trying to target or clamp down on tax minimisation in certain ways. The new tax agent compliance is a bit of one that's showing some teeth and a little bit more of a concern for professions like ourselves. We now, as of 1 July 2025, we are now obliged to report if any of you guys, any clients, are doing anything that they call false or misleading. Yeah, so if we're in the know that you're doing something that you shouldn't be, we are obliged now to report, and that never used to be the case. I guess, yeah, we're under strict, code of ethics and everything else under the sun. So you could say, well, that's always been the case, but it's now in black and white that we're supposed to report you if you're doing anything untoward. And that is more of a material nature. I don't think if you claim $100 and you're not supposed to, I'm pretty sure it's not going to be picking up on that. But they talk about if it's of a material nature and they haven't given numbers or thresholds, I guess it is a discretion thing on what we're supposed to report. And there's also dob-in provisions now. So accountants are now obliged to dob in another accountant if, let's say, someone comes to buy fields from a different firm and we've discovered that there's been some false and misleading claims or treatment that has gone on, which is considered material, then yeah, we're obliged to report the other accountant, which it doesn't sit well, to be honest, with other accountants in the industry of the obligations to do that. But that's just some new measures, government introducing and the tax agent board are introducing to try and crack down on tax fraud or skullduggery, I suppose. So please make our life easy and don't do anything like that. And ATO communication is increasingly electronic. So please make sure your email addresses are up to date. If you change them or if you're not getting correspondence, please sing out, because gone are the days where you could easily open up the post and see your activity statement or any notice, tax debt notice, for example. They're going to rely on communication records that they have, and it's no excuse, unfortunately, to say, well, we didn't get it because our email was down or had the wrong email address. So, just be conscious. We would sometimes prefer the paper copies ourselves, but we're fighting a losing battle there. So, please make sure your emails are working. That pretty much covers everything I was hoping to go through today. If you've got any queries, there's my email and phone number. I think Shane's going to get out the notes following this, so you can reach out to myself or your contact at Byfields. But was there any final questions there, Shane?
No final questions, Glenn.
Yeah. All right. Well, thanks everyone for joining. I hope it didn't bore you too much. But just a bit of an insight on what the tax man is up to, and we know Big Brother is watching. So, but thanks for joining, and stay tuned for our upcoming topics in a few months' time. Okay. Thank you very much, everyone. Thank you.